this bounce. How real is this going to be?
I think we've had a lot of movements in the markets quite quickly. And so just given the degree of volatility that we have right now, it makes sense that we have a little bit of a bounce. We're still in wait and see around further data. And maybe there's some optimism around trade deal. But let's be real, it takes a lot of time to negotiate trade deals. It took NAFTA nearly 5 years, the USMCA nearly 2 years. If we're trying to negotiate all of these bilateral trade agreements across 50 countries, that's likely going to take some time. So I don't think we're nearly out of the woods yet, but it makes sense that we see this kind of bumpiness in the markets.
Nancy, what do you think about today's bounce?
Well, I think the bond market's been telling us, hasn't been panicking, has been telling us that maybe we're not in a recession yet, and we may not go into one. So given that as a backdrop, I do think the noise will continue. So China wants to make a deal. I don't know what that means. And I think that's been the instance throughout this, that's been the case throughout this whole situation. The chart, it's going to take a long time to get over the chart that had all the countries, some of which don't even have people on them. And I think, the interpolated tariffs were a real confidence killer for investors. So let's see how it goes. But we got some earnings today. We got a big buyback announcement. Our case has been that company buybacks were going to put a floor under the stock market. And we saw today that Broadcom has done just that. So we'll see. So I'm with Stephanie.
I'm sorry to interrupt you, Nancy. That's such an interesting point, because I'm curious, if companies do have cash on hand to deploy right now, would they be better suited utilizing that cash to move manufacturing back to the U.S. or to do some buybacks and potentially cushion the stock a little bit?
I think they'd be better served doing buybacks. The moving supply chains or manufacturing back to the U.S. is going to take years, to Stephanie's point. And I think that's the naivete in all of this, that who's going to get hurt? The lower income cohort will get hurt by this, and we're already seeing layoffs being announced at auto manufacturers. Now the administration is floating an export tax credit, so you get your money back at the end of the year if you're a manufacturer in the U.S. I don't see how that raises revenues. Farmers being subsidized. So this has not been well thought out, and I think it's going to continue to morph as we go through the coming weeks.
And Stephanie, as you look to Q2 earnings season here, what are your expectations, and how does that play into kind of your outlook for the economy as well? Like, what do you think we're going to learn about the health of the consumer this coming cycle?
Absolutely. I think we're set for a real shift in the company guidance this quarter. At the beginning of the year, we were quite optimistic on the outlook for mid-double-digit earnings growth and quite broad-based earnings growth as well. But now I think what we're going to see is a likely broad-based wave of earnings downgrades and a lot more caution in company guidance moving forward. Because of the uncertainty around the trade front, this uncertainty can be quite paralyzing for businesses figuring out where to invest, how much to invest, who to hire. And I think that's the real risk, and something that likely hasn't really catalyzed in the markets just yet.
Yeah, go ahead, Nick.
Well, so Stephanie, the S&P X Mag 7 is trading at 15 times. But the problem is we don't know, as you point out, what earnings are going to be. And so I'm curious what you're forecasting for earnings on the year and in the first quarter. Because managements, as you point out, have no incentive to give guidance. I would duck if I was the CEO.
Right. Well, right now, consensus expectations have come down from 14% at the start of the year, guided this year, to something around 10.5%. That is around the long-term average of the S&P. And if you think this year is going to be anything like our long-term average when it comes to earnings delivery, I think that's probably a little optimistic. So any kind of forecasting right now is a moving target. It will really depend on the degree of severity of the actual tariffs that are put in place and how long it takes until we get some degree of clarity. But I think that's the real risk.
I've been trying to get investor playbooks from everyone as much as I possibly can, because there's obviously so much uncertainty right now. So I'm going to ask both of you for your best investment idea in this environment. Stephanie, I know you've been looking global a lot as well. Do you have one specific investment playbook idea for our audience that you think is the best kind of hedge right now?
we've had a long period of U.S. exceptionalism. And when we write our long-term capital market assumptions every year, we've continued to view the long-term outlook, the U.S. exceptionalism likely going to dim a little bit. It's not going to be the only game in town. But what we were missing was any kind of catalyst. And we might be seeing that catalyst finally emerge, and particularly for investors that are looking at their portfolios that have only really owned the US, this is finally that catalyst to open your eyes and begin to invest and look elsewhere as well. Right. It's not the end of US exceptionalism, but it is a real recalibration that we think will endure.